Hi, thanks for joining the Westwood Energy Update. This is Parag Sanghani with the Westwood Salient Energy Team. May was a correction month for energy equities broadly. If you look on page 2, you'll see that midstream corrected about 3 to 4% depending on the index, while large cap energy companies corrected about 5.5%, and producers were down 8%. Services companies were also down 6% during the month. In fact, the only positive energy sector during the month was clean energy, which was up about 13.5% as measured by the iClean ETF. Year to date, we've seen energy equities across the board do well. Midstream is up 18 to 20%. Large caps are up about 25, 26%. And if you look at producers, they're up over 30% on the XOP, and services companies are up nearly 37% looking at the OSX index. Even utilities are up about 5.5% year to date, and clean energy stocks are up nearly 44% through the end of May. So we've had a strong start to energy for the year, and we hope to see continued outperformance through the rest of the year. What we are looking at, though, is the drivers behind that performance. If you look at oil and natural gas, in the month of May, we saw both were down. Oil was down about 17%. Natural gas was down about just shy of 5%. The oil correction, we think, was driven by news that there might be a resolution to the Iran war. As of yet, there hasn't been a resolution. We are hopeful there will be one. But year to date, what we've seen is oil prices are up significantly, over 50%, while natural gas prices are down about 5% on a year to date basis. We do think that a correction in oil will occur once resolution has been announced in Iran. However, given how much inventories have drawn year to date because of the closure of the Strait of Hormuz, we think that going back to the lows in the beginning of the year are highly unlikely for oil prices. On page 3, you can see that in May, the underperformers were predominantly the companies that have benefited from the war. We see the LNG exporters were down meaningfully, as well as some of the NGL-focused companies. In terms of the winners for the month, it was your lower beta Canadian companies in general that outperformed, as well as a few that outperformed idiosyncratically, driven by increasing drilling that is expected out in West Texas. On page 4, year to date, the winners really are your behind the meter solution companies like Kodiak or Solaris. And then you've also had outperformance in the LNG companies like a VG or a Next Decade. Thirdly, you've had the oil-centric pipeline companies, Plains All American, and the NGL-centric companies like Targa and ONEOK perform well. As prices moved higher for oil and NGLs, you saw these companies have some of the best convexity to capture that move higher within their systems. And then finally, what I really wanted to focus on today is this graph that came from Piper on page 5. There are 2 graphs here. The top one is the correlation of energy with 10-year rates. The bottom is correlation of S&P 500 with 10-year rates. And what's really interesting is there are definitively 2 different regimes in which the S&P 500 and 10-year Treasury yields correlated. In the period from the late 60s through the year 2000, the correlation was negative, and it was nicely negative, meaning that when yields on 10-year Treasuries went up, the S&P 500 usually went down. But from the period 2000 to 2022, we saw the correlation became positive, where 10-year yields would go up and the S&P 500 generally would go higher as well. We think that what you're seeing is a difference between an environment in the 60s and 70s and early 80s, where higher rates meant worry of more inflation, meant that the economy would be slowed down by the Fed in order to tame inflation, and therefore equity prices would likely move lower as the economy slowed. From the year 2000 to 2022, The government was working, the Fed was working very hard to stimulate the economy. And so every time rates would move up slightly off of very low levels, the equities would generally move higher, with investors believing that growth was potentially accelerating. What we think, and what Piper is now showing with some of the data, is that we might be entering a regime shift where higher yields on 10 years are now negatively correlated with S&P price movements. What's really interesting with their analysis is that in this environment where higher rates equal bad equity performance, what you want as a hedge is something that is generally positively correlated throughout cycles with yields, with rates. And the top graph here really shows that, with XLE being positively correlated with rates through multiple different cycles over the last 25 years. And it would create a natural hedge in a portfolio if inflation, in fact, does run away from us here over the next few years, like it did in the 1970s. We thought it was a really interesting data point, and we wanted to share it with all of you. If you have any further questions, please reach out to your Westwood representative, and thank you for your time and your interest in Westwood Energy Strategies.